Yeah, we had a really good conversation this morning in Traders Lounge, and I wanted to expand on it a little bit. This is going to be in regards to understanding the trade-off between the probability of making money and how much money you actually make. And for me, it makes picking strategies simpler, and it helps me to understand that I no longer have to like say, okay, here's a little box. I have to have this particular setup, this particular dynamics to do this particular strategy. It's just a little different. It's a little different. And let me explain what I'm talking about here. So probability of profit versus ROI, right? Return on investment. Or you could say probability of profit. Actually, I like the acronym, POP versus ROI, right? These are on opposite sides of a teeter-totter. So you have to ask yourself, the situation here is market is down big. Let's say I want to start a long-term portfolio. I want to pick up some things. I want to start to get exposure to the market. And yes, it looks terrible. It's in a downtrend. You know, a short-term trader would be hard-pressed to justify buying a stock in a downtrend. But if we're talking historically, if you don't think the world's going to end and you're long-term optimistic, every time the stock market goes down 10, 20, 30, 40%, it is a buying opportunity, okay? It's not a matter of if, it's a matter of when we're going to bottom. And maybe there's more pain ahead. I don't know. In the short run, who knows? I just know that when prices are that far off the highs, that the forward returns go up. They get better, not worse, right? Look historically. Hey, if you bought the S&P 20% off the high, what was your return over the next 5 years? If you bought the S&P 500 30% off the high, what was your return over the next 10 years or 5 years? If you bought it 50% off the high, when you're getting those low prices, your forward returns go up, which is intuitive, but emotionally, it's hard to pull the trigger, right? Everybody wants a discount, but then when it gets there, they're too scared to do anything about it. So the thought was, okay, so if I want to start getting some exposure to the market, let's say I'm using the S&P or IWM or maybe the NASDAQ, like broadly diversified big basket of stocks. We're not trying to pick an individual company. So how do I go about doing that? I have three, I think, easy choices from a strategy perspective, okay? The first is I could just buy shares of stock. Okay? And I have about a 50% chance of success. We could go up, we could go down. That would be my probability of getting a profit. And I have unlimited upside, okay? So one way that I could try to, start to dip my foot in, dip my toe in, I guess is the phrase, is, I buy shares. Now, not necessarily right this second, like maybe you wait a little bit and you get a pattern or whatever, but the point is that's one vehicle you could use, okay? But maybe that probability, that 50-50 thing just doesn't resonate with you and say, boy, I'd like to increase my odds. I'd like to do something where I have a 60% chance of success or 70% chance of success. Well, you must know that if you do that, you're not going to have unlimited upside anymore. There is a cost. There is a trade-off that you have to face by increasing the probability. You're not getting something for nothing. So one way that I could increase the probability a little bit is I could buy shares of stock and then sell a covered call. And let's say I sell 30 delta covered call, okay? So I'm going to say sell a 30 delta covered call. Well, what did I do? I'm still bullish. I've just tweaked the probability, and that in turn influences the amount of profit. So my probability of profit when you do a covered call is greater than 50%. And if you sell a 30 delta covered call, your probability of getting some profit is, 55% probability of profit. Like you haven't You haven't elevated it that much. I will say that you have a 55% probability of a profit, but you also have a 30% probability of your maximum profit. Okay, whatever that is for this particular covered call. So if I wanted to tweak the probability a little bit better, but cap my upside, maybe I buy the S&P and sell a 420 covered call or something for June. Okay. And in that particular case, by the way, if I'm using SPY and I'm selling an out of the money covered call, let's just run some numbers here. We're at 395 and a half. If I sold the 30 delta, that's the 414, I get $6. Plus I can make $19, like $25 is probably my maximum upside at that point. So I'm limited to maybe a $25 max profit. Okay, that's $2,500. Something that's pretty good, but it's not unlimited. It's not unlimited. So I juiced the probability. I reduced the profitability, or how much I could actually make. If I say, oh, I want to tweak it a little bit more, I want an even higher probability, I'm going to just sell an out of the money 15 delta naked put. Okay, well, now you have an 85% probability of profit. And that is probability of max profit. And it's effectively the same as probability of a profit as well. But man, I've taken the pop from 50 to 85. That's pretty good. You think I'm going to have unlimited upside now? No way, Jose. You're giving something up. So if I were to sell a 15 delta put on the S&P, I get $400 or so. So how much can I make? $4, right? Profit of $4. Not unlimited, not $25, $4. Okay. You could have 3 different traders. All 3 want to pick up some exposure to the stock market. Okay. How do they go about doing it? There's dozens of strategies. Well, instead of just thinking about the strategies by name and think, oh, I got 12 different choices, what do I do? Just think about it from the perspective of probability and return on investment or profitability. What do you want? Do you want more upside? You're not going to have as much chance of making the money. Do you want a greater likelihood of success? You're not going to make as much money. So these days, when I build trades, I don't really complicate the matter. I just say, I don't know, what do I want here? And the reality is all 3 traders are going to make money if the stock goes up. But they won't make the same amount of money. Okay. All 3 traders might lose money if the market goes down, but they're not losing the same amount of money. They've used their brain and their preference and their personality to maybe pick the right balance for them between probability and profitability. And so for me, it's like, listen, I don't even care what you do. I just want you to make an informed decision here. What do you want? You want to go for straight stock? Go buy the S&P here, right? Or whenever you get a bullish signal, right? You want to increase the odds? Go for the out of the money cover call. You want to increase the odds even further? Go for the out of the money naked put. I use these 3 interchangeably: long stock, covered call, naked put, all variations of the same thing. And by the way, the simplest ways of using options to enhance stock ownership are not to do fancy pants spreads. You can, but the simplest way is just don't buy the stock, sell a put, or don't buy the stock only, buy the stock and sell a covered call. With those 3 strategies used, month to month, you really start to see how you're in control of the probability, you're in control of the accompanying profitability or return on investment potential. And then you just decide what you want to do. And the reality is, last point, you can often do all of them. You'll see traders are like, well, I've already owned some stock, but I want to buy more. So I'm going to do that through selling puts. Or I own stock and I sell puts when it's down, and when it goes up, I sell calls. I'm just using the options market to try to enhance the probability. and better control how much money I make. So don't forget that as you're picking option strategies, always a trade-off, probability versus profitability, or how much payout you actually get.